Have you ever wondered if PayPal as a company and as a stock is undervalued? There has been a lot of news about if PayPal is undervalued, why is undervalued. They have relatively a new CEO. So we are going to take a deep dive into the company and try to answer the question, is it worth to buy the stock now? Is it going to go up and down? Of course, these questions are much more complicated as we are just saying it out. So today we are going to take a deep dive into their financial reports and also take a look how they actually make money. And before we go to the video, I would like to ask you to hit the subscribe button if you would like to have more videos about analyzing stocks. And feel free to comment the company that you would like to get analyzed in the next video and just check out the description. So first of all, we are going to go into our Google Sheets where we are able to plug in the stock ticker symbol, and we will get most of the financial data from here. And first, we are not going to check the stock price as it can be misleading. Instead, we are going to look at the real financial data to have a full picture if there could be any undervaluation. So first of all, we will see the key valuation formulas for example, the PE ratio, which is about 17. So you can get the idea that 17 for a fast growing tech company could be low. So it's quite interesting. The second of all, we'll see that their profit margin is 14.31%. which is quite low for an average tech company. But we are going to get into that picture. Why is it that low or relatively low? And the current ratio, which is the current assets / the current liabilities, is 1.29, which is quite low or quite good actually. It should be over 1. And the debt to equity ratio and the long-term debt per equity ratio is also below 1, which is great. It shows that the company is in a good financial situation. And the price to free cash flow ratio, which is similar to the price to earnings ratio, instead of it uses the free cash flow and not the net income, is also 16, which is relatively low for tech companies. As we know, PayPal is not paying out any dividends. So even though we are tuned for dividends channel, there is not going to be any dividends involved in this video. And the earnings per share next year is 5.7, which is about 10% growth. So it's looking great. Return on equity, 20%. We are right here in this row. Return on assets is 5, and also return on investments is 13. Just before we go into their financial statements, like the income statement, balance sheet, and cash flow, we are going to understand how they actually make the money. And for this reason, we are going to use Guru Focus as a great tool. So first of all, we are going to see one main bracket, which is going to be their revenue source if we're going from the left and we are going towards the right. So first of all, they make most of their money out of transactions. So if you have never heard or used PayPal before, basically they are a payment tool between the buyer and the seller, and they take a small percentage share of the transaction. And they also own Venmo as one of their companies, which is not available in Europe, although it's very popular in the United States. So first of all, 91% of their total revenues are from transactions. So let's say they are very much focused on one revenue source, and the other rest of the money is coming in from value-added services. So of course, PayPal is not just payment services, but they also have their own platform where you can send money to your friends and other tools. And if we step a little bit right, we will see their gross profit and also the cost of goods sold. So basically, the profit line is going to go upwards and the costs are going to the lower bracket. So we can see basically that how the cost structure is building up, and by the end we can see that their net income is about 17.5%, which is very good. If we look, this is a tech company, so it's easy to scale it in a way. So we can see that the company is well profitable, although it is working relatively lower margins for tech companies. But I think you can't really compare, for example, Microsoft, MasterCard or Visa with PayPal, as they are so much in a different world. You could compare it to Stripe, for example, so that would be a great exercise, although Stripe is not yet a public company, so I'm not going to involve it in this video as of now. But if we just go take a deep dive into their income statement, we can basically see their revenue has been increasingly growing, although in the past few years it has been slowing down. First of all, might be the business have hit its ceilings, or let's just say that it have gone into a size that growth is slowing down. It's absolutely normal. If you would look a fast-growing tech company, you would also see this trend. Their revenue is still growing, there is no issue, and their gross profit is still growing, also there is no issue. And if we would look at their net income, because it's quite important if we analyze a company, we can see that their net income they're quite profitable at the end. And by percentage-wise, you can also see it down here that it can go by double digits. Of course, 2020 was a very good year since everything was closed, so there were more online transactions, and by 2021 they had a slight decrease in their profitability. Well, this is normal, since if you see how big a difference was 2019 and 2020, so the company had a significant growth between the COVID years, and we will see the valuation, how did it change between these years in a little bit later. But we can see that there was a slight drop, well, not a slight, actually almost a half drop if we would see in 2022. This was sort of a trend. You had very high years in 2020, 2021. So somehow it had to be rationalized. So you can see that it is very similar to the 2019 numbers if you would compare it. But the real topic is how much they spent on certain things. You know, in 2022, they have spent more on research and development, which is not a bad thing. And their selling general admin costs were increasing. So this could bring down their profitability. This is the main reason the profitability came down. You can also see an increase on the cost of revenue. So this gives us an example. If a company is spending more on the research and development, that's not an issue if you are a long-term investor. You're looking at a longer-term perspective of the company, that research and development spent in the current year will generate more revenues in the future, hopefully. And of course, it gives you a basic understanding on what's happened before the net income perspective. But if we look at 2023, we can see that their profitability came out to be an all-time high, almost an all-time high. So no, it's actually an all-time high. So it's very good that the company is back on track, and we are going to see how their price to earnings is moving and in a historical sense. But before that, we have to check two more very important things from the income statement. One of them is the share outstanding. So basically, if a company is issuing shares, that means puts more shares on the market. If you're a current investor or a stockholder, that means that you're actually getting diluted, which means that there's a loss in that sense, that there are more investors on the price. And if the company is buying back shares, that's actually good for yourself, because the company is actively spending money from their equity to get more shares from the market. That means reducing shares outstanding. It's great for you as an investor, but it's not a bad or a good decision at the end. Of course, the price results are the best, but if you have to understand why the company is buying back or why the company is selling out more shares, to get a full picture if it's a good or a bad decision at the end. But if we would see that the shares change in general are decreasing, this is good for long-term investors, especially if we look at the 2023 numbers. So let's say this company has been doing wonderfully in the past year, although the share price haven't really appreciated it in this sense. If you look at the free cash flow has been increasingly growing. If we would look the 2018 until the 2021, where we can see some slides, This can be because of higher capex, capital expenditures. This can be an issue in some sense, but this can be also an investment for long-term positions. So let's get into the best stuff. Well, not the best, but let's say a good thing is to see that the historic price to earnings ratio, and you will get a sense that actually their historical price to E ratio is actually very low. If you see the 2021, 2022 numbers, you can see way higher price to earning ratio numbers. And if you look at the price to free cash flow ratio, you will see a very similar tendency that 2023, 2022 was actually sort of undervalued in the sense of the price to free cash flow if we would compare it to previous years. So I'm actually seeing some undervaluations in this sense. Of course, there is a new CEO, this is a risk, but also it could be an opportunity of growth for the future. But for this reason, let's do a discounted cash flow analysis. As you can see, the Google Sheets is doing everything automatically. Basically, what we are going to do is take the 10 years of free cash flow and try to forecast it for the future. As you can see, the average growth rate of the free cash flow for the past 10 years is about 19.79, let's say 20%, which is quite good. Let's just imagine if you would have invested in 2014 into PayPal, you would be much more gaining in the stock price in this sense. So 20% average growth rate is significant, although if we would look the past 5 years or the past 3 years, we will see free cash flow decreasing, especially in 2023. As I said, this can be a current issue, but of course it's harder to forecast for the future. So I'm going to go with the general 6% for the growth rate, which is not a high thing, but just we have to remember, we have to get this mathematics towards the next 10 years. So we have to be very secure about our forecasting. It's much easier to do a discount rate, and it's much harder to make a growth rate, as the growth rates will be the same each year. Of course, you can rethink about it next year and let's say modify it to 5 or modify it to 8. But with the current situation, you would have to go with either 6% or anything else. But when you decide the growth rate, you have to be very strict that you have to hold this for the past 10 or the further next 10 years. So you have to be very wise in this sense. And for the discount rate, I'm going to go with a general 11%. It could be higher than, let's say, the industrial average is saying, but I would rather go on the safe side again than make a wrong calculation, make a wrong investment on there. So we would get that in terms of the discounted cash flow model to equity, we would get a $68 per share price, which is, let's say, if it's undervalued or not, and the current share price is 64. So there could be a slight undervaluation in the current mathematics, but I have to say that I think if you're a long-term investor, and this is just my opinion, not a financial advisement, but I think the 6% is slightly pessimistic. So if we go with the 7%, which could be still hold up for the next years, we could actually see a better result, even though that the discount rate will stay in this sense. So I would say that PayPal is a very interesting company. Of course, everyone has to dig in for their own investments and also check their financial reports, understand what the CEO is going to do for the next years. I'm not an investor in PayPal. I am considering to think about to own the stock, although it's hard for me to understand the total industry where it's heading for the next 10 years. So I thought this will be a helpful video for many of you. So please make sure to hit the subscribe button, check the description, and also mention a stock that you would like to get analyzed for the next video. See you in the next one. Have a good day, and don't forget to watch my 2 previous videos. Have a nice day to you. Goodbye.